Hi guys, this is Dan from the Investment ABC, and in this video I want to give you a small update on the stock markets and why I think we might be at a turning point right now. In my last update I said I was expecting the Dow to rally further than the 23,000 points I was targeting prior. I said that I was expecting the Dow to reach somewhere between 25,000 to 26,000 points before we start to roll over again. I think I might have to readjust my prediction. To me, it looks like the markets will most likely roll over from here on. I bought put options on the Dow today to profit from declining prices. The reason why I changed my mind is the historical oil price collapse we witnessed today. Currently, WTI futures prices for May 2020 are trading at minus $38.5 per barrel. That means oil storages are full and companies are paying money to get rid of the oil because they can't just dump oil somewhere in the environment. I have never seen something like this in my entire life, and I'm sure many futures traders haven't done that either. Oil is sometimes a good leading indicator for the global economy, and it looks like my preferred scenario of a 1929-like depression is slowly turning into reality soon. If oil prices stay low for too long, a lot of companies and maybe some countries even around the globe will most likely go bankrupt if they don't get a bailout. Furthermore, some other entities like hedge funds lost a lot of money today betting on rising oil prices. These hedge funds maybe have to liquidate some of their long positions in stocks, which might put pressure on the markets in the next few days, in my opinion. The stock markets bounced sharply off their lows because the market was just too oversold and investors, especially the newer ones, haven't seen a proper bear market yet. They are trained to buy the dips and they think the Fed's unlimited money printing can only result in higher stock prices. Well, the market might teach them a really heavy lesson for life soon. In my opinion, the Fed laid the bait and inexperienced investors will take it. The Fed said that they will print unlimited amount of money, but in my opinion, they will stay behind the curve, which will result in further price declines. In the last week, many of my friends who never bought stocks before told me that the stock market looks like a great opportunity and asked which stocks they should buy. This fact, and together with headlines in major newspapers giving advice on which stocks to invest in, is similar to Barron's article where they predicted Dow 30,000 shortly before the crash, a clear warning sign for the prudent investor. People are FOMOing back into the market, hoping to see all-time highs in a couple of weeks. The market needs those people for another leg down, in my opinion. This illustration here is showing our human behavior, and it really is always the same, because we never change as human beings. Human beings tend to believe that they are smart, and we come up with so many reasons why this time it's going to be different. We just don't want to see the warning signs. We are currently in the complacency phase, in my opinion. Bear markets don't end like this. They're emotionally draining the bulls until they're fed up and throw in the towel, swearing never to invest in stocks again. The market is always anticipating, and with such a run from the lows, the market is anticipating that the economies will be reopened very soon. The health issue we are having now is resolved in no time, and that after having only in the US more than 22 million unemployed, these people quickly will find a job again. Exactly this scenario is already priced into the market right now, in my opinion. I think there is a lot of room for disappointments for investors. Even if tomorrow the mentioned perfect scenario would play out, the market would start to roll over due to buy the rumor and sell the news. Once more and more companies start to report earnings and give a guidance, stocks will react, in my opinion, even if a lot of people think bad earnings are already priced in. It is very unlikely that all these unemployed around the globe will quickly find a job when more and more small businesses are closing permanently. And like I said, the spending of one person is the income of someone else. The bigger companies will start to go even further the road of automation. Robots won't get sick and are more efficient than human beings. Instead of rehiring 10 workers, they will maybe rehire 5 or 6, and the longer this lockdown madness goes on, the more damage will be done to the economies. Not only the oil market is not buying the recovery in stocks, but also the bond market is flashing warning signs. Bond yields are dropping again, which indicates that the big money isn't believing in a quick recovery either and hiding in bonds despite the low rates. Big money is well connected and running the show. If it wouldn't anticipate declining earnings and dividend cuts for a longer period of time, bond yields would rise. If we now have a look at the Dow Jones Industrial Average, we can see that we are at a critical level here. We closed under the 50% FIB retracement mark and are now about to break the upwards trend line. If we have a significant down day in the markets tomorrow, we could see the end of the bear market rally in my opinion. My strategy now is hedging my core stock positions with put options and taking advantage of the decline. I'm expecting tomorrow another red day, and if that happens, I will readjust my stop loss order to the price levels where I bought my puts, just in case I'm wrong and the Fed pumps the market despite the turmoil in the oil market. Grab your popcorn, guys, and let's see how things play out. If you like this update, please support the channel, hit the like button and share my videos with friends and family. I also love to read and hear your comments on what you think where the markets are heading and how the declining oil prices will affect the economies and the stock market in the short and the long run. Bye guys, and see you in the next one.